Good morning, everybody. Welcome back to another episode here at the Cyber Traders. I have a new friend of mine, John Keshner. He's going to talk about a little bit of himself, about the market. We're going to talk about his research and, basically very similar guy like I was, being a market maker on the floor, but on the other side of the middle part of the country, where in the Chicago, where I was on in New York. And I'd like to say, John, thank you for being here. It's great to see you coming on the show for the first time. How's everything going?
Well, so far so good. It was a little bit bouncy this morning with the, Besant was talking and, the usual drama that goes on out of the White House with the tariffs and everything else. But so far so good. Interesting times, let's say that.
Yeah, it was a pretty bouncy morning this morning. I mean, and we could talk about some of those things too, because I'm still, I have like one foot out the door and one foot in the door. And it's just like, if you've been trading for a very long time and like we're always trying to, try not to catch a falling knife, but eventually a knife is going to hit the floor and we're always trying to find that. But yeah, very interesting times, the tariffs, with your history and my history and stuff like that, we've been through some crazy markets. If it was COVID, well, everyone was in COVID. I mean, but like, the financial crisis, the 9/11 and all that stuff, it's just very, very interesting times. But so what exactly are you seeing? What's going on? What did you see in this morning that really kind of made you throw you off?
Well, more broadly than this morning, just looking back over the past week, I'll talk more about this later, but I have gone from a guy that traded in the pit, was basically a seat of the pants trader that was listening to the crowd and seeing where the bids and offers were, to being a very systematic and mechanical trader. It helps my discipline. It helps to keep my eye on the ball when, the news is swirling out of Washington. But just our tactical models turned back to positive at the end of last week. What I've been noticing is asset expansion in the Qs, in SPY, starting to see some money flows, just short term, but money flows going back into XLK, which is technology sector, XLY, XLY. Consumer discretionary. That was not the case a month or so ago. Everything was defensive. It was healthcare. It was utilities, still is utilities. So things are starting to the market is starting to get less spooked than it was a month ago. And we believe that a really important bottom was made on April 7th because of a lot of kind of technical quantitative stuff that we could talk about in a little bit more detail. But yeah, I mean, this is going to be a bouncy market. This is going to be a spooky market for some time, but internally there's people that are getting back into the market after being in the turtle, for a couple of months.
Well, how long have you been doing this? Over 40 years. Am I right?
Yeah, 43, I think, this year.
43. Beat me. I was like 35, I think I've been doing this for. But, so you've been around since the crash of 87.
I was on the trading floor in the S&P 500 pit during the crash of 87. So that was my first crash. And that was like a John Wayne bar scene fight that went on for 6 hours. It was nuts.
So, I mean, I never experienced it back then because I got in around 94. But how do you compare like that crash to like everything that we've seen? Did people experience what you went through back in 87? I never asked anybody this, but like, I guess the first time I've asked this question, but was it like COVID? Was it like, the financial crisis? I thought the financial crisis was probably the worst. I mean, that was pretty bad.
It was different. Because I was in the middle of the beehive, right? So observing a crash now, sitting at my desk, sitting in my office and observing it right in the middle of it, you tend to look at a lot more of the minutia. Like what I remember in 87 is there was a couple of guys in the booth that signaled into the pit, instead of to buy 100, they bought 1,000. and the emotion is, and by the time they figured out that they had 900 more S&P futures contracts than they wanted, the market was probably down another 20 or 25. And I remember seeing this poor guy get escorted off the floor by a couple of burly, security guards. He didn't do anything wrong, but he was in the middle of this food fight, and he moved the wrong part of his body. So, when you're on the floor, you notice all these little things, guys getting shoved out of the pit and fighting in the corners, and you don't really see the big picture. It feels the same. It still makes your gut sick. It's like someone punching you in the stomach, but you're looking at it from a different angle.
Wow. I realized, I remember you had all those signs and stuff like that. You talk with your hands. It was like, depending on how much you want to buy and stuff like that. I mean, I remember we used to write hand tickets, to buy a certain thing and whatever. But we did everything over the phone because we were on a NASDAQ market maker. So we were like on the floor, but that was a pretty crazy time. So you've been doing it that long, you've been around. So what, but then now, I mean, after doing this for 44 years, you started a new company called Asbury, right? Asbury Management, I believe.
It's Asbury Research.
So
Asbury Research, yeah. And we launched Asbury Research in 2005. So this is our 21st year.
21st year. So how'd you get into the research business from being a floor trader? How did that come to fruition?
Interesting. Funny you should ask. I was on the floor for probably 3 or 4 years. I was a little bit older. I started on the floor when I was 24. A lot of the kids started on the floor when they were 18 and 19, and they were interested in finding girlfriends and going to parties. And I was trying to figure out how to make money. Just a little bit more. I was a little older. There's a big difference between 18 and 19 years old on a summer job, and trying to make a career there, and bartending at night so you can afford to be there during the day. So I noticed that the guys that seemed to be doing the best were the guys that were walking around, and they were using point and figure charts at the time. So they had those little green sheets of paper all kind of folded up so they can hold them in their hand, and they were charting. So I started to get interested in that. Went to the board of trade, bought some chart paper and some, some of the materials and the rulers and stuff that you use to make your own charts. And in my apartment, in my bachelor apartment, nobody was allowed to go into my kitchen because on the kitchen table was where all my charts were. So I would keep charging it by hand, 12 or 15 of these, of the markets. Started out in the ags and moved over to foreign currencies. So a few years after that, I just started to put some support and resistance levels on trading cards. I would fill them out by hand. I gave them to about 20 traders in the pit for a month, and hoping somebody would offer me a job, somebody would offer to pay me. Nobody said a peep. So I stopped. I said, well, obviously this wasn't a really good idea. Over the next 2 or 3 weeks, I had a dozen of these guys that said, hey, this is really great stuff. Why did you stop? And what do I got to pay it and start it up again? So I ended up kind of starting this little charting company on the trading floor, which, as a kid, 28 or 29 years old, I'm getting a couple $100 a week, a couple $100 a month from 12, 15 guys. That was good money back then.
Right. You're talking a long time ago. I mean, that's big money back then versus what today is. So that's when it came to fruition and started. And then what happened to the floor of the Chicago? When it started, is it still there? I mean, I know they still have a little pit in the back, right? Is it still running? Or, I mean, it was like you said, it was like the Titanic. Everyone just left.
Well, yeah. So in the late 90s, I was getting older. I really didn't want to do this for the rest of my life, flashing in the signals from the booth. I didn't want to go in the pit anymore. Pit's young guys. It's 25, 35-year-old guy, especially, the S&P pit at that time is pretty raucous. I knew that I didn't want to be doing that when I was 60. So I needed to make a move. At the time, the off the floor trading, the electronic trading started. There was, what's it called? The CBOT had one and the Merck had one. They were two
Martin.
separate off the floor exchanges that traded 24 hours. So I knew it was coming. So I left the floor in the late 90s. I worked for a couple of different companies for 2, 3, 4 years, but just focusing on the research instead of doing the research as I was a floor analyst basically when I left. So my job would be, I'd have one of my traders from New York and say, John, we got to buy 500 S&P 500 contracts between now and Friday. Have fun. And I would have to figure out through the charts where I'd be buying the dips, buying the support levels, buying the breakouts. So at the end of Friday afternoon, we had a nice, average price, for those 500 contracts. So when I left the floor, I focused more on doing the research. That's what I was really good at, and that's what I liked. And that eventually evolved into starting Asbury Research in 2005.
Yeah, now that changed the subject, but I mean, I've been to the New York Stock Exchange a lot, and like, was there a lot of fights down there on the pit?
A handful.
A handful, right?
Because the fines and the damage that you did to your reputation down there. Figure there's in the S&P 500 pit, there was hundreds of guys in there. They traded with each other every day. A lot of them went out for beers after work. These were guys that you depended on to have your business. So, not to mention the fines and the suspension. There were some suspensions, where people lost their mind and something bad happened, but it was really, it was so damaging to you in so many ways. You would have thought there was some chest bumping and stuff that went on, but really not a lot of stuff that I saw ever got out of hand. And it's because you had to come back to work. You had to trade with these guys the next day. If nobody liked you, if you were cheating, if people felt you weren't being honoring the trade you made the day before. Well, I saw it happen to a guy where, and I won't mention the pit or anything like that, but I saw it happen to a guy where one time's an accident, 2 times maybe, but there was a pattern where this guy wasn't honoring his trades. He was putting different prices on his trading cards than the other side was putting on the other. So what happened is the guy ended up standing there for a month or two, and nobody would trade with him. You'd be in the middle of the pit, bidding, offering. Nobody would trade with him. They trade around him. They trade through him. He ended up leaving the exchange, selling his seat and leaving the exchange because your word's your bond down there. And it's not because we're a bunch of Boy Scouts, but that's our living. And your reputation down there was imperative to staying down there and making a living down there.
Now, did you own a seat down there? Like, do you have to buy your seat like the New York Stock Exchange, or you had to work for somebody? I mean, nobody just go down there and just trade.
There were guys that, had enough money where they just went down there and bought a seat for $1 million back then, and they would stand around and watch for a year and figure it out. I never owned a seat. I leased a seat for some time. I was given a seat. Back then, I used to fill orders of options orders in the FX pits.
Mm-hmm.
But I never owned a seat. Back then, a CME seat, it was a gold badge. Back then in the 80s was $1 million.
It was $1 million. What did they sell them for? I know they sold them when they cashed out in New York. They got like 10 million or something like that. 15 million. I think they moved on after that when it became electronic. So now that happened, now you are where you are today. I know you do a lot of presentations. You told me like you do presentations for Fidelity and Schwab, and you've been all over the TV. What have you to tell the listeners out here? Do you see any changes in the market or anything they should be looking for, they should be worried about within your research? I mean, there's a lot of people that are trading. You hear such a bad thing that it's a big failure rate, and it really is. And a lot of it is not being educated. But what have you noticed? Any changes or anything that you would kind of recommend that somebody should be looking for, not get caught up and be part of that failure rate?
The speed of the market is much faster. Sector rotation is where you can really see it. 10 years ago, I had built a model that was a momentum model. to tell me which sectors that I wanted to be overweight, which ones I wanted to be underweight. It worked great for years. I mean, it was a really good model. Then all of a sudden it stopped working. And so I broke it down into pieces and looked at it. And what happened is those relative outperformance trends that I was getting in the sector space that would last at that time a quarter and a half, anecdotally, it was 6 or 8 weeks. It sped up that much. So what happened was,
which sectors are those that you're looking at? Like, are you bullish today or bearish today on any of them?
The sectors in the S&P 500 are the ones we look at, and we use the spider ETFs for those. So right now, so we have a model called the CEF model, and it measures the velocity of the assets that are moving around those 11 sectors, out and in. It's a lot faster. It's a lot more agile than the momentum model that I spoke of that I had 10 years ago. And right now, XLU, XLC, and XLK are the 3 sectors that the money is moving into the fastest in multiple time frames. Now that changes. There are times where when I look at sector rotation, in most years, think of the 11 sector spiders as 11 horses in a horse race. And once around the track is 1 year. Most of the time, those 11 horses stay in a pack, and a horse will win by a length. A sector will win by a slight amount. It'll win by a nose, a neck, or a length or two. That's the normal sector rotation. That's what we're seeing now. But there are some years or 1 or 2 of the horses, the sectors break out of that pack. We had that happen in 2022 and in 2021, where energy was 2021. If you remember energy, when the market was going down, energy took off like a shot, and our model caught that. And we energy XLE outperformed SPY by 40% between January and June of that year. So if you can catch those sectors as they break from the pack, we don't see that yet, right? So right now it's XLU, XLC, and XLK. But the way that you make money in sector rotation is being around for those atypical times where 1 or 2 of those sectors break out and they take off. You could have huge years on those years.
So is that the Asbury 6 model that you use? Is that in simple terms?
That's called the CEF model. This particular model is CEF, and CEF stands for Sector ETF Asset Flows.
Okay.
So it's SEAF. We have about a half a dozen models, and they all do different things. But the CEF model measures the velocity of money moving around the 11 sector spiders, and it jumps on those that have the most money and the most aggressive money going into them in 3 different time frames. And that's where we know where to go. And then on the flip side, energy has been near the bottom all year. That's where the money's been coming from. So if you look at the sector rotation, it's kind of like a monopoly game where you got a fixed amount of money and it's rotating to the different sectors, just like around the board on a monopoly game. Right now, money's coming out of energy, and it's been going into utilities actually mostly this year. That's been the best relative performer versus the S&P this year, and we've seen it in the model this year. Most of the time this year, one of the top 3, according to the model, has been XLU for defensive reasons, right? The market's going down, so people are comfortable with utilities.
Well, maybe what could you show us that model a little bit? I'll share my screen. Maybe we'll
Sure.
show us exactly what you're talking about.
Right. So we're at asburyresearch.com here. This is the landing page. The research center is the paywall. So we're going there, and we'll get into, let's see if that worked. I don't know if it's taking my mouse. Can you do it from your side? Can you hit research center button? Research center button here. It's not accepting my mouse click.
Yeah, right now we're just seeing your website.
Yeah, it's not letting me click on the it's not accepting the click for some reason.
All right, well, we'll get back to it. But yeah. But with that said, with the market with technical analysis, all that stuff, is it more important today with the fast markets to look at what you're using?
I think so.
Yeah.
I think so. Especially, I think the situation that the market is in now, the market is a discounting mechanism, and it can discount bad news as long as it knows what the bad news is. I mean, even if we go back to COVID was a global pandemic, but the entire world was working on a solution, and everybody was on the same page in government, just kind of across all various boundaries to try to get to the other side of it. The market was able to discount that. The problem now is with the mixed messaging that's coming out of the White House. Tariffs, no tariffs, how much tariffs? We're talking to these people. No, we're not. All of that. Businesses have a hard time with that. How do I know if I want to open up 2 new offices over the next year and hire 10 more people? How do I know when I don't know how much the cost of materials is going to be? I don't know what real estate prices are going to be. I don't know where interest rates are going to be. I think the part where there was talk about firing the Fed chair was a problem for the market, a problem for the bond market.
That caused the market like crash. That got people very nervous.
So where I'm going with this kind of a long windup is everything that we do is data driven. So we build models that have different components to them, kind of like when you're building, if you ever saw the movie Moneyball, and you're building your baseball team, and this guy, he gets on base a lot, right? So you want him number 1. He's 30 pounds overweight and he's never played before, but he gets on base a lot. So you put that guy at number 1, you got a guy at number 2 that's going to move the runner, and blah, 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 all the way through that. That's how we build our models. And our models are looking at stuff like relative performance, which tells you where the money wants to go. And that tells you a lot about what the money thinks of the character of the market. Is it going into value or growth? Is it going into tech, or is it going into utilities? We look at asset flows going into some of the bigger ETFs, the SPY and the Qs. We're looking at stuff like standard deviation. We're looking at market breadth. And what that allows us to do is, instead of focusing on the TV and who said what, I'm watching how the market is reacting to what it's seeing. Because the market could care less about what I think. But if you look at the right metrics and you back test them in sets so you can see if they work well together as a team, that's kind of the premise of what we do. I sleep better at night and I make a lot more money because I'm not trying to handicap every little piece of information that's coming off of the news, coming off of the wire. All I'm doing is judging what the market thinks conditions are based on a select group of indicators that we've back tested, and we know they work well together, where if one fails, 2 or 3 others will, sort of pick it up on the other side.
Well, what's interesting, John, that you bring up, I had a lot of gurus like you on here and researchers and stuff like that. And like, we're the same family, we don't pick a side. We're traders. So we kind of always look at what we just think as a trader, no matter if you're anti this or positive that. But and I always find that people make the biggest mistake is that they take things personal, and you can't take things personal. Like, and the reason why I asked you about, do people fight on the pit? And like, you can't. I mean, they're going to be there every day. They're your teammates. You know what I mean? And sometimes we screw up, and sometimes you got to help them out. Otherwise, you're not going to be there too long. So what's the biggest mistake that you see it's going to happen, or that traders do? And what are you looking with these tariffs? I mean, what are you focusing on with your indicators? What do they tell you, depending on, if this happens, I'm looking here. If that happens, I'm looking there. If this happens, I'm doing nothing. I mean, what do you see? And for that you can tell everyone here what they should be looking at with your 45 years of experience.
The biggest mistakes I think that I've made was, and I was forced to be a seat of the pants trader because I was on the floor of the exchange. And, you stand in the pit and, you watch the bid and the ask, and you try to determine where the market's going by what you might see around you. And, people are watching bonds or currencies or whatever. I was never very good at that. It's a lot of guesswork. What I'm a lot better at is designing models that tell me on a day-to-day, week-to-week, month-to-month basis what the market thinks. So what I do a lot less of is, I think when people trade, and I've seen this, sometimes people trade like sports betting. So they get a dog in the fight, so to speak, right? So they like this because they like this politician or this politics, or they bring all these other things in there, and you really get yourself in trouble. You shouldn't have a dog in the fight, and you said it. You shouldn't come in here and say, well, I think ultimately this tariff is going to work, or it's going to fail, or this guy is going to be really good for us, or the Fed's going to do something in 6 months or 9 months. And 6 months and 9 months in this business, you're broken on the street. So I've kind of given up all of my opinions to looking at a prescribed set of data that works well together. And I'm not hawking a product here, but rather talking about a philosophy that I have. So if you're trading for yourself, ask yourself, which indicators work good for you? Which are the indicators that you're comfortable with, and start to look at, so you have a short list, right? So you've got 20 indicators that are on your package, whatever chart package that you use. Figure out which ones have been the most reliable to you, and make sure that you never trade against those. The other thing that people do is, if you're inherently bullish and you sit down at your desk in the morning and you're ready to trade, if you look at the right indicator with the right time frame, it's going to tell you what you want. You don't want your indicators to tell you what you already want to happen before you sit down. You have to know what your time frames are. So if you're a short-term trader, you might have a 30-minute short-term time frame and a 3-hour or a 4-hour intermediate term chart. Stay within those time frames. Know what you're looking at. If you're looking at a tactical move for yourself, you have to know what your tactical time frame is, and use that across all indicators. As soon as you start varying, then you're all over the place and you don't know where you're going.
Yeah, I mean, that's exactly what I was going to lead and ask you right there, John, is like, if someone just got started, and we don't want to see anybody get hurt, because we're one big family out there. What would be the one tip you would give them, to teach them how to trade?
People look at trading the wrong way. When I started, I was in the commodity space, right? So every long-term chart, like if you were looking at soybeans or cattle, it looked like a sine wave. Over time, it was sideways. Then I got to the equities, and the equities looks like this. So you have an inherent upward bias with the stock market that is a huge lead. So trade with the trend, and look at trades not from how much that I think I can make, but how much money do I have to put up in order to participate in the move right now. That means you need to know where support levels are. You need to know when markets might be short-term oversold. Get as many conditions for yourself and have a plan. Just to say, well, I love this market, I'm going to buy it today. If you buy it out in the middle of nowhere where there's no support under you, nothing to lean on, you don't have any risk reward. In our shop, the last thing that we look at after we see asset flows are good, relative performance is good, 5 or 6 things are all where I need them to be to participate in that market. The final thing, and the most important, is where can I buy this today, and what do I have to risk? If you got to risk 10% of your portfolio to make a trade, I think it's too much. 20% is certainly too much. That gives you 5 swings of the bat and you're done.
Right.
So make sure that when you're putting a position on, you ask yourself not how much money I'm going to make and what kind of car I'm going to buy in 6 months, but where am I wrong? How long can where can I put this trade on and lean on a level so I don't get forced out of a trade a half an hour early, and then I've got to spend the rest of the week watching it take off like a shot and I missed it.
So is that how so if somebody wanted to learn that type of a style, because listen, there's so many people out there, and everyone's always listening to different gurus out there. Some people do options, stocks, some people do research like you are. How did you get started where somebody could follow you to get part of that research?
Well, we've got, I think, a good place to start. We have a premium research product that's $1,800 a year. And that's a little pricey for some folks, and we know that. So what we started to do is we have a Substack newsletter now. It's substack.asburyresearch.com, and there's a free component to that. So if what I'm saying is of interest to you, makes sense to you, that's a place where you can go and you could get a little snippet of what we do and how we look at trading, how we look at investing there for free. If you like it, I think it's $25 a month. It's entry level for traders that are just getting started. So you can get some ideas what a guy that's been doing this for 40 years pays attention to and thinks is important. And for education, we've got Asbury Research YouTube channel. We have our own YouTube channel. There's a lot of videos there. I do a podcast called Following the Money twice a month. That's another place. It's not going to cost you anything, and you'll get some ideas on how we look at markets and how my kind of unique experience coming from the trading floor, kind of where it steered me through my career.
Yeah, that's like my famous line. I love that line. Follow the money. That's all I tell everyone. Just
it's all that matters.
It's all about, every single person I have on here, they all say the same thing. And everyone out there just makes the same mistake. They take things personal. They look at something, they like the industry. I'm like, I like the industry too, but doesn't mean that's where the money is. He's got to follow the money where it comes down to it.
Great story. A guy that I had who's now one of my friends. He's actually become a friend. He's a doctor, pretty prominent neonatal doctor from the South. Started out as a research subscriber and told me he wanted energy. He loved energy. He thought energy was way too cheap. I don't remember, it's 2-3 years ago. I want to buy energy. And I told him our CEF model was showing that the money was coming out of energy and it was going into something else, whatever
right.
It was. It's okay or whatever. And he's going, yeah, but it's cheap. And I'm reading all this stuff. I said, why pay me $1,800 a year if you're not going to follow, what we're trying to show you here? So anyways, he bugged me for 6 months. He wanted to buy energy. Energy went down and down and down and down. Finally, it was like right around Thanksgiving that year. I actually I phoned him. I don't normally pick up the phone and call because we have a lot of customers. I can't do that. There's too many of them, not enough of me. But I called the guy up and I said, the CEF model showed that there's aggressive money going into the short-term time frames, the trading time frame, also the tactical. Now you buy energy. He bought energy. Energy went straight up for 4 or 5 months. If he would have bought energy where he wanted to, he would have rode it all the way down and rode it all the way back up and tore his hair out for 9 months and probably made 10 cents out of the whole deal. So knowing when to buy is more important than knowing what to buy.
Mm-hmm. Do you see any industries, but before we go and finish up, anything of industries that interest you that people should be moving forward with the tariffs and stuff like that you're focusing on?
That's getting into forecasting, right?
Yeah.
Because what do I think the tariffs are going to do to bend the sector space so certain sectors succeed? I have no clue. I think the best thing that I've learned over the past 20 years is that forecasting is a euphemism for guessing. It's very, very difficult to do forecasting. I know how to read charts as well as anybody. I've been doing this all my life. Right now, the most consistent trend of sector rotation, where the money is going there consistently most of the time, has been XLU. It's been utilities. It's been the best performer this year for that very reason, because there's been money going there. that could change in 2 weeks. If we get a bottom down here somewhere, which I think we made a important bottom on April the 7th. I've thought that for about a month now. I thought that while it was being made, if that's the case, that money's not going to be in XLU 3 or 4 weeks from now. It's going to be in the faster horses. It's going to go into XLK, XLY, the places that people want to be when things are okay. But again, one errant tweet here can turn this whole thing on its head.
Anything around 2 seconds.
So you really got to watch you really need to watch indicators and not the TV.
Metals, anything new in metals? Gold, anything you follow? Okay.
We've been in and out of gold since middle of January. We bought gold, sold it, made a little profit. We had a little break. So this is the third trade that I've been in gold so far this year. They've all made money. We just bought SLVP, which is the silver miners.
Okay.
About a week ago. Yeah, I think there's still room to go higher in that space, especially if this uncertainty stays here, because whatever comes out of the White House, I don't think is going to move the price of gold, but it could move the bond market and it could move the stock market. So I think a lot of people are saying, okay, where do I hide here that's not going to get influenced by the chatter?
Yeah, the only thing I did know is silver didn't move that much as gold did, though. That was the only thing that I had.
The other thing that we've been involved with this year is we've got another model called U.S. versus the world, and that looks at the U.S. SPY, S&P 500 versus 25 different foreign equities indexes from all over the world. Middle to latter part of January, Germany showed up and Italy showed up. So we overweighted Germany and Italy. A month later, that you saw outperformance coming out of the South American countries, Chile and Peru. And now I think of those 25, there's only 2 that are not outperforming the S&P 500 on a strategic basis. That's Taiwan and China because of the tariff thing, right? That's, directly related to how that seesaw is going to balance out between the tariffs between us and the Chinese. So that's another place I think you can continue to look at foreign equity indexes. And as long as, the global relationships are all changing, right? 70, 80-year relationships that we've had since World War II, trading partners, people we're friends with, people that we back up, all those chairs are getting rearranged. So I think it's been clear to me that managers, even though they're, we've had a nice bounce off of the lows in April, there's a lot of managers that are putting money overseas where that's not been the norm. Normally the U.S. outperforms everything most of the time. That hasn't been the case this year, and that's because of the uncertainty here. The equity investors are looking to reallocate to get some diversification in case this goes south.
I know it's been a hell of a roller coaster, and it's like I said, but early this morning, it's like a falling knife, but you're trying to catch that knife, and I don't know. I think we're bringing pretty close there. It's holding pretty tight. I see some stocks, even on the stock market side, that I do. A lot of it tests some real major supports. But with that said, John, just one last thing. I just want to leave my listeners with just, if you could just give one piece of advice to stay of today's markets, what would it be?
Make sure you know your risk on any idea that you have. Make sure that you know your risk. Make sure you're putting your positions on either after a breakout, that everybody can see. If you're the only one who sees the breakout, it's not a breakout, right? So it's got to be a trend line, a 50-day moving average, something of that, or you fall into an old support level, which could be an old high. If you wait, because uncertain times, tons of volatility, you need to be more careful as to where you put your positions on than you might in a more of a calm environment. So I think that under these conditions, something simple like making sure you know what your risk reward is every time you push that button to make a trade is really important now.
Well, that's great advice. And John, thank you so much for being here. And thanks everybody for being. Tomorrow we'll have Jack Brewer here. It's at 11 o'clock also in the next podcast. But don't forget to register for John's YouTube event and also his promo for his research. John, thank you so much for being here. Appreciate it. And we will make a couple of shorts out of this. We will have it on YouTube channels. Just make sure you like it, friend it. And if you want to attend any future events, even with John, we have a little QR code in the top right-hand corner. Just take your phone, scan the QR code, and we'll see you there. John, thank you so much. And good luck in the trading. Trade safe. All right.